Good evening, sir.
Evening, how are you?
Well, and you?
Fine. Where are the others?
I
That's,
think they'll join us now.
let's just give them
Yeah.
let's just give them 1 minute. You know, people are tired. We have been doing classes
Mm.
since February, and the way it is, we don't have a gap because we're always approaching a test, so it's hectic.
Yeah, and we're supposed to do those new finance movement topics.
Yeah, so we will see. Maybe we'll have maybe 1 week break when we are done with test 3. Maybe we can just take a 1 week break. Yeah, because it's hectic.
Yeah, anyway, right now, just need the commitment and the
Yeah,
understanding of the principles.
yeah, but I think now you are fine now. You can see the light now, ne?
Very much, 100%. And
You see, when I
I
tell
can feel I just need to practice more and more and more.
tell people that make is not difficult, they say, Aish, you talk too much. It's not. You will see. You can see for yourself now.
You are right. We need to understand the topics.
Yeah, you cannot do make. That's why I always say you can't start just by going to a question bank. It will confuse you more. You need to go through topics, then you now go to the question bank after you understand the principles, right?
Yeah.
I think we are almost up here. Let's start with the class. So in our test 3, we are going. Test 3 and 4 is going to be finance. So which means we are going to look at the finance part for test 3, then the finance part again for test 4. Then the exam now will consolidate everything. So let's go through the finance. You can see in our topics, I'm picking the most difficult ones, especially the calculations first. Then we can go to check the theory when you are done with the calculations. So I'm not following the order of the study guide. I'm just looking at the topics which are coming for test 3. Then I pick those ones which I know are the obvious ones and are almost difficult. Right, so let's start with the topic for today, capital structure and the cost of capital. So when we look at the capital structure, we're looking at how the business is financed. How are we going to finance our business? So which means we're looking at it's either we're going to finance our business through debt or through equity. So that would be the capital structure of the business. The business is financed itself through debt and equity. So those are the main capital that we can have. We can have, it's either we can borrow from the bank or we can issue shares so that we can finance the business. So basically in the capital structure, we are going to focus much on how the business is financed and what is the cost of financing that business. So that's basically what we'll be looking at in capital structure. So we'll be focusing on long-term liabilities. We don't focus on short-term liabilities. We focus on long-term liabilities, which means here we're talking of loan. Here we're talking of ordinary shares. So you can finance your business through loan, a bank loan. It can be a bank loan. It can be, you can issue debentures, or you can go to the bank and get a loan, or you can issue the remaining equity shares, the ordinary shares for the business. You can also issue those ones to finance the business. So that would be the capital structure of the business, which means we have debt and equity. And when we talk of debt, remember, debt is different from equity in the sense that the owners of debt will not control the business. This one, they will have a fixed return. So the owners of debt will have a fixed return. They don't control anything. The ones who control are the owners of equity. Those are the shareholders of the company. So when you are financing, one thing that you guys need to look at, especially when it comes to commenting and reporting, look at the cost of debt and the cost of equity, so that when you give your comments, you should also take into account those costs. How should we finance? What is the advantage of financing through debt? And what is going to be the advantage of financing through equity? Then you look at the cost of debt. What is the cost of debt in the capital structure? And what is the cost of equity in the capital structure? So in that way, you can now tell, remember, you are a management accountant. As a management accountant, you are not just there to give figures. All your figures should come with a recommendation as a management accountant. You don't just crunch figures like financial accountant who just crunch figures and say this is the profit. The management accountant will tell us why we have this. So which means you should always scrutinize everything so that you give appropriate advice to management about what needs to be done, what's best for the business. So in that way, you become a useful management accountant to the business. Right, so let's quickly look at the theory before we go to the question. Right, so when we are financing, we can have equity. Equity, we can have ordinary shares. So in your question, always look for ordinary shares, retained income. All these forms are part of equity. Non-distributable reserve. Preference shares, remember we say preference share is a hybrid. They call it a hybrid debt. It can be equity, it can be a liability. It becomes equity if it is irredeemable. That's when it becomes equity. Then if it is redeemable, then it is a liability. It is redeemable when, if you check in your question, they will tell you that preference share redeemable in 5 years, which means the company will redeem back these preference shares in 5 years. So in that way, it becomes a liability. It forms part of the debt. That's why we call it is a hybrid equity, because sometimes you can find it as a liability, sometimes you can find it as an equity. So in your question, always look at the word irredeemable or redeemable. Then you know. But another trick that you can look at is they will give you this. Then you know it's redeemable. If they don't put this years, then it's not going to be redeemable. Then it's going to be irredeemable. So it becomes part of the equity. So those are some of the things that you should look at when you are answering your questions. Right, so let's look at liabilities. You can have, in your questions, you can have long-term loan, debentures, bonds, and these are preference share as well. So it's going to be part of the capital structure. So a capital structure is made up of all these, but the business can have 1, 2, 3 of them. It depends on the business, how it decides to finance itself. Right, so let's look at existing capital structure. What is this existing capital structure? When you are looking at your questions, you will find that you can have existing capital structure, then there's going to be a new project that need to be financed. So which means you are going to deviate from the existing capital structure now, because you are now going to add an additional capital that is needed for the new project. So in that way, you need now to change the structure based on the target capital structure of the business. For an example here, if our existing capital structure, we have equity, you guys, you must have your financial calculator close to you. I think when we do the question, we're going to use the financial calculators, right? So here you can have equity, liability. Then because we want to finance a new project, we can now take a long-term loan. So if we take this long-term loan, let's say of 1,000, then it is now increased the structure of our capital. It's no more 1,200. I think there is a part where we should look at that part, because normally they will ask you how the business should finance the new project. So in that case, you should know how do you share this 1,000. I think you will see when we do the question. There is another area that I see we always have a challenge. When we talk of debt to equity ratio and capital gearing, they are two different things. I always see people, they take them as one thing, right? So if it is debt to equity ratio, you are comparing the equity and the debt. So you are looking at the proportion of debt as compared to equity. That is going to be your debt to equity ratio. So when you look at debt to capital employed now, you are now looking at the total capital employed. So that one is what we call the capital gearing ratio. So always look out, if the question says calculate the debt to equity ratio, you should differentiate it from debt to capital employed here. There are two different things, the debt to equity ratio and the debt to capital employed. Right, let's look at, okay, so here, okay, so the capital gearing is the one that you are now going to compare how the business is financed. So here you are looking at how the business is financed here. How the business is financed. That's your capital gearing ratio. So if your debt is 33%, obvious, once you calculate the debt, there is no need for you to calculate the equity. You just subtract it from 100. 100 minus 33 will give you the remainder, which is going to be equity. So which means in this case, the business is financed through 33% debt and 67% equity. In some of your questions, they might ask you even to comment, what do you think, is it a good financing capital structure based on the calculation that you have? In most cases, we expect a business to be financed through low debt as compared to equity. The reason being that debt is going to be repaid soon. So if you finance your business through debt, then there are chances that in future you're going to run a challenge, because once these people need their money, then you are not going to be able to have a strong capital to run the business. So the debt must always be less to the equity. You must ensure that you finance your business. Don't finance your business what we call high gearing ratio. So the high gearing ratio is a situation where the debt is higher than the equity. So in that case, the business is not healthy, because the moment you start to pay this debt, then it means the capital of the business is going to be drained. There will be no enough capital to run the business. So a business should not be highly geared. It must at least have more equity than debt, so that the moment you pay debt to the owners of the debt, then you are going to still be able to continue to run the business. So that's another thing that you should look at. Even when you are advising management, this is another area that you should look at. The debt is higher than the equity, which will give a business a challenge when they want to, after they pay the debt to the owners of the debt. Right. So let's look at capital structure target. As a management accountant, you should have a target capital structure for the business, right? So the target capital structure is what you expect should be the capital structure. That's the target capital structure. What do you expect should be the capital structure? So that one is going to be the target capital structure. Okay, let me just admit these other guys there. Where are they now? I can't find them now. Okay. Right, so that's basically here. So when you look at the target capital structure, you are looking at what do you expect the business to be financed. Like here, the business should be financed through 40% debt and 60% equity. So that's the target capital structure. So as a management accountant, again here, every time when you calculate your capital structure, you should also compare with the target capital structure. Did you deviate much from the target capital structure? Like in this case, let's say this is the business target capital structure, that is 40% to 60%. Then when you are required to make a comment, let me just meet these other guys here. Okay, so I was saying here, this is our target capital structure, and let's say this is our what we have calculated is our current capital structure. So there's something, if we need to finance business, let's say there's a new project here, and our target capital structure is 40% to 60%. And our existing capital structure is 33% to 67%. You as a management accountant, you should look here. You can see our target is falling on debt. So which means here, the first financing capacity should be through debt here. You should first finance through debt, because debt has not reached its target capital structure. Those are some of the elements when you do your question. If they ask you, how are you going to finance this business? You should also look at the existing capital structure and the target capital structure. Which element of the capital structure is not yet reached its target? So if something is not yet reached its target, then that's the one that you use to finance the business first, so that you can try to maintain your target capital structure. Right, so that's basically another key thing. I think we're going to look at more questions there. So here in this part, they say a company's target capital structure is 40%, and 60%. So the debt is 500 and equity is 1,500. So when the question requires you to determine the target capital structure, which means you are no more going to use this. You are now going to share based on here, which means you are now going to have a total which is 2,000. Then debt is going to be 40%, so you give it 800. Equity is going to be 60%, then you give it 1,200. You are now no more going to rely on here. So if the question requires you to focus on the target capital structure, then it means you need to use this. This is your target capital structure. You are going to share based on the target capital structure. Right. Then there is a point when a business, these are some of the questions that you should expect in the exam. Achieve target capital structure through expansion program. You are provided here with an existing capital structure, like here. This will be our existing capital structure. Then you need to invest in a new machine, and you want to determine how the asset should be financed to maintain target capital structure of 40%. These are the obvious questions in the exam. These are the obvious questions in the exam. We should be able to answer this. So if the question say this is our existing capital structure, here we have our existing, this is our existing capital structure. Then you now have a project that need to be financed for 1,000. So the first thing that you do is to go and add up your existing capital structure. Then it gives you a total. Let's look at what is done here. You can see here, because here they say determine how the asset should be financed to maintain the target capital structure. The target capital structure is 40%. So what you are going to do now is you will focus on the existing capital structure. They add up to 2,000. And if you add 1,000, the new project that need to be financed, you are now going to have 3,000. That is after the expansion, right? So after the expansion now, you need now to share. Debt must have, so which means in this case, debt is going to have, after the expansion, debt is going to have 40% times 3,000. That is going to be debt. Then equity is going to have 60% times 3,000. That is going to be your equity. That is after the expansion. This is here. So which means debt is going to have 1,200 and equity is going to have 1,800 after the expansion, if you are using the existing capital structure. So what it means here is you take your existing capital structure total and add with the expansion program. Then that total you share using the target capital structure. That is what is going to happen after expansion. Right? Then there is going to be a current position for debt and equity. Current position is going to be 500 for debt, 1,500 for equity. After expansion, it's going to be 1,200 for debt and 1,800 for equity. So the required funds now is going to be the difference between the current and after expansion, which means once you allocate this column, what you are going to do is to find the difference between these two columns. So that is the required funds from each capital. So in this case, we are going to have 12,000, 1,200 minus 500. So from debt, we should borrow 700. Then from equity, we should issue shares for 300. That's how the program should be financed. So if the question requires you to determine how a program should be financed, the first thing is to go to your existing capital. What is the total existing capital? That's the first thing. Because this one I need to emphasize, because this, if you write make and you don't find this question, I don't think it will be a make exam, that one. This question must be there in all the papers. So that's why I'm emphasizing on it. So what I'm saying here is, if there is an expansion program, the first thing is to look at the existing capital total. Like in our case, is 2,000. That's the existing capital. Then when we have a new project, then we are going to add the new project. Then it is going to give us 3,000 after the new project. So you want to share based on the target capital structure. So which means debt is going to have 40% of this, equity is going to have 40% of this after the expansion. So the difference between the two is what you are going to take from each capital, which means here we are going to have 700 from debt and 300 from equity. So that's how you need now to tell us after, because you don't just leave the calculation. Because if you give this to your manager, maybe the manager does not understand this management accounting, then you just give them this table. He doesn't understand it. So you should now give us here and say the project should be financed through equity. You can issue shares, or we can go and take the retained income if it is there. Remember, retained income is part of equity. So if we still have retained income, we can still take to finance, or we can borrow from the bank. So that will be your recommendation. After you have done your calculation, the project should now be financed through equity of so much, through debt of so much. So that's basically here. So this part is very important because you have to find it in the exam. In test 3, it will be there. So we need to understand, how do you finance an expansion program? If the program is expanded, then we finance based on the target capital structure. Don't deviate from the target capital structure. You should finance based on the target capital structure, so that you can now take from everyone as the target capital structure. Remember, here you don't want to deviate from the target capital structure. So which means your target capital structure is the one that is going to guide you how you are going to finance the expansion program. Right. Unless if there's a question, I think if there's anyone with a question here before we go, I think we're looking at, yeah, I expect questions on this one, because this one is very important. Anyone with a question on this part?
Yes, are they going to give us the expansion amount?
Yes, the expansion amount will be there.
Okay.
IMEC is just ABC. Everything will be there. You need to know what am I supposed to do. There is no question where you are going to guess any figure. All the figures will be provided. What is needed is for us to know what are we going to do with those figures. So in your question, they will come here and say, existing capital structure is debt 500 and equity 1,500. Then they will tell you now the expansion program is going to need 1,000. So what is important for you now is to know, how do I finance now this 1,000 new project, which means now you focus on your target capital structure. Right, so that's there. I don't know if there's anyone with another question before we go to something else.
I would also want to ask, can you hear me?
Yes, we can hear you.
Yeah, I want to ask you that as a managerial accountant, if you want to set a target structure? What is it that you check?
Sorry?
What is it that you check if you want to set a target structure of a of capital?
If you want to
If
do
you want
what?
to if you want to set a target structure, what is it that you check?
You want to set a target capital structure.
Yes,
As a management accountant, you want to set your target capital structure.
yes.
No, that one is going to be based on how the business want to finance. Remember, every business will look at how they need to finance their business. So that one, there is no strict, like straight formula. It depends on how the business want to finance itself. Some of the business might need a high debt based on their advantages of the debt. Some of the business might not need a high debt. So that one, it depends on how the business is trying to finance itself. There's someone also who is raising the hand. You can ask the question.
Hi, how are you?
Fine, how are you?
I'm good. I just need to ask with regards to current position. There's 25% and 75%. When do we use those percentages?
25%.
Yeah, gearing ratio, I see there's 25% and 75%.
Where do you got those ratios, those percentage?
You see where it says answer, there's equity, the heading current position,
Okay.
is those
Sorry, I did not explain this one. Remember, we did gearing.
yes.
This is our gearing ratio. What did we say is the gearing ratio? We say the gearing ratio is the percentage as compared to capital employed. Am I right? So, which means if you want to get this 25%, it must be 500 over 2,000 times 100. Then it must give you this 25%. So, which means here the business is financed through 25% debt and 75% equity. So that's the gearing ratio. So remember, I was saying at the beginning, if the question requires you to calculate the debt to equity ratio and the gearing ratio, they are two different things. So in that case, you should be able to know when you are calculating the gearing ratio, which figures are you going to use? When you are calculating the debt to equity ratio, which figures are you going to use? So this is the gearing ratio. The gearing ratio is how the proportion of debt in the capital structure. That's the gearing ratio, the proportion of debt in the capital structure. So if you check here, these guys, they have 25%, which might even be a disadvantage. If you guys go through your theory again, you can also see the advantages of financing your business through debt. Anyone who has gone through that, the advantages of financing business through debt. What advantages can we get from financing our business through debt? Have you guys have never come across that one from your 2602?
Deducted.
Yeah? If you finance your business through
We
debt,
deduct
sorry?
we deduct tax on the interest for the
Yeah,
for
that's true. 100%. You'll see that if you finance your business through debt again, you are going to have an advantage to pay less tax because it's going to be a deduction. So that way, it's going to be an advantage again. You are going, and what else again can be an advantage for financing your business through debt? anything that can be advantage to finance a business through debt.
Better credit score.
Cash flow, yes.
Credit, yeah. Credit score. A better credit score.
Yes, yes. What else can we have again if you finance your business through debt? We should know this. We finance our business, we are going to pay less tax, and what else can be an advantage? Whatever money that you are going to make, these guys, they have a fixed return, so they are not going to bother us. If we make a lot of money, we just give them their interest if it is 5%. Unlike if your business is more financed on equity. Remember, these guys, the equity shareholders, they look at the profit. How much did the company make? Then they bargain their dividend based on what the company make. So in that case, it will be a disadvantage to the business. So it will be an advantage for the business now to issue debt, because we know whatever we make is ours. Them we are going to give them what we agreed upon. So those are some of the things that when you are doing your theory questions, you should understand how to apply some of the principles. Right, so let's look at, right, we are going to look now at the market value. What is this market value? When we talk of market value, in most cases, we're talking of present value. So if you are calculating a market value of something, just know that I'm calculating the present value. That's the market value. So there's going to be the market value of equity. This is the formula. You guys, you need to know these formulas. Market value of debt, you need also to know this formula. Market value of debt and the market value of ordinary shares, you need also to know this formula. What else? Let's look at now the weighted average cost of capital. What is this weighted average cost of capital? If we borrow a loan and equity, what we call the weighted now is a one cost that is going to represent this, which means we are going to have, if loan is bearing an interest of 12% and equity 16%, the weighted average is going to average these two into one cost of capital. So that is going to be the weighted average cost of capital. Right, so in that case, they say, please mute yourself. They say,
and not your hands.
can you please mute yourself, please? Right, so the weighted average cost of capital, just know that you are going to do the average. So this is the return that the company needs to achieve in order to achieve the expected return on both equity providers and debt providers. We have to achieve this percentage so that we can meet the equity providers and debt providers. So when the question requires you to do the weighted average cost of capital, they want you to come up with one return that the company needs from all these capital structures. So that is going to be your weighted average cost of capital. Then let's look at the cost of capital. Here, you guys, you need to know this formula. When you are doing the ordinary equity, you use this Gordon's dividend growth model. Cost of equity is equal to D1. D is dividend. Is it not there? Sorry, I did not put anything. Okay. So D is dividend. D1 is expected dividend. So when they give you a question, they will give you about the expected dividend. So this is the market value of share. PO is the market value of share. Then this one is the growth. So when you are using this formula, growth, it means D0, D1 minus D0 is going to be your growth. D0 is the dividend before it increases. Then D1 is the expected. So when you are calculating your growth, you use your D1 and your D0, then you have the growth. If D1 is 28 and D0 is 25, then it means growth is 3 rand. Then you convert this to percentage. So that is going to be your G. I think they did it here. Yeah, it's here. D0, 1 plus G over P plus G. That is if you are adjusting from the current dividend. That's how you apply your formula. So this formula is very important when you are calculating the cost of ordinary equity, which means you are going to have your dividend, your market value, and your growth. Then they will give you the cost of them ordinary equity. Then you can also use the capital asset pricing model. Like in this one, we are now looking at some diversification in the investment in order to avoid risk. So that's the capital asset pricing model. You are trying to diversify in order to avoid risk. So you are now going to use the risk-free rate and the market return and the market risk premium, then the beta coefficient. So this one, the B is the unavoidable. You can is the unavoidable. This one you are going to invest in risk-free investment like government bonds. You know, if you loan a government, obvious that man will come back. So these are the risk-free. So in that case, you now use this formula to calculate the cost of capital. But at your third level, you are not told which formula to use. You can use the one that you know. It's only when you are doing your second year when they will tell you use the capital asset pricing model. But when you are doing your third level, you just need to know which formula are you comfortable with to calculate the cost of ordinary share. Right, then look at preference shares. When we look at preference shares, I think here there's another formula that is not there. When you look at preference share, this formula is for irredeemable. Irredeemable, that's when you use this formula. If it is redeemable, it means you are now going to say N is equal to interest is equal to PMT is equal to, then present value is equal to future value is equal to. That is if it is redeemable. But if it is not redeemable, then you use this formula. Annual dividend over market value, then you are going to have the cost of irredeemable preference shares. But as long as they are redeemable, then you are going to use this. So that's another. But another thing that we should look on preference shares, if they are, we should look at, remember these guys, they receive dividends. So you are not going to do it after tax. You are not going to apply tax. You are not going to apply tax on preference shares and ordinary shares. Who has an idea why don't we do after tax on preference shares and ordinary shares? Why don't we do our calculations after tax for preference shares and ordinary shares?
because their tax is already deducted. So it will be
Speak up, speak up, speak up.
But we don't apply tax on those ones. It's
The reason why we don't apply tax on ordinary shares and preference shares. You guys, you do tax. All of you, you did tax. So you should know dividend tax. When you are doing your tax on dividend tax, you should know that part.
Aren't they exempt from tax?
Yeah.
exempt. Yes, yes, that way.
Why
They're
do
exempt from tax.
why do we exempt them? Those who did tax, they should know why dividends are going to be exempted when we now calculate the taxable income. Why do we exempt dividends when we are calculating the taxable income? I will not tell you. I'll ask you guys to go and research, because that one is tax, pure tax. The reason why we exempt there is, remember, there is a dividend tax. When before we give money to ordinary shareholders, there is going to be a dividend tax that is going to be charged on them. So now here, if we tax them again, it means it's going to be a double taxation. So that's the main reason why you see we say section G what dividend exempted. It's because they've already been taxed. So you cannot tax them again. They come to the books of the company or the books of an individual after they have already been taxed. The company that is responsible for issuing dividends is the one that must submit dividend tax to SARS. So which means you are going to receive your dividends after tax. So that's the reason why we exempt them when we do our calculations. Right, so that's there. That's tax. If you go and look in your tax, you will see that part for dividend tax. Right, let's look at the cost of debt. The cost of debt we should just apply after tax. Remember, our tax now is, I did this notes when the tax rate was, but when it comes to this 28%, 27%, remember the current tax rate is 27%. Always look at the question. Some of the question might just still keep to the 28%. So don't rely on the current rate. Look at what the question is saying. Does the question say I must use 27% or I'm going to use 28%? So the cost of debt is a percentage that you are going to be given. If they say similar debentures are trading at 9%, so you should give after tax cost. So which means you are going to apply the 27% or the 28%. That's why here we say 1 minus 28, which means it's going to be 9% times 0.72. That is going to be your debt after tax. So always at third level, your debt must be always after tax. If you are given a percentage, 9% is the cost of debt, then you should apply the after tax, unless the question specifies that the after tax has already been applied. Right, then the weighted average, this one you can use a formula, but at third level, this one normally for second year. For third level, you use the table to do your weighted average cost of capital. Like, let's look at what goes to the weighted average cost of capital. Right, if you are calculating your weighted average cost of capital, I think I included the notes here on it. Right, this gearing, well, if you already talked about it, let's just leave it there. I want us to go to here. This is the main part of the question. Steps to perform to calculate the weighted average cost of capital. You want to calculate your WACC, your weighted average cost of capital, which means the first thing is to determine the components making up the capital structure. Here you are looking at ordinary shares. These are the components. You are looking at preference shares. You are looking at loan. So you look at the question and see who are the components of the capital structure. Everything at third level, these components, you need to revalue them to market values. When they talk of market values, you are revaluing them to your present value. Then you need now to look for the tax after tax. If it is a loan or a debt, then you need to convert it to after tax, the cost. When we talk of the cost, we are talking of the cost. If you go and borrow money from FNB, they will tell you, okay, we will give you 100,000, but you need to pay 12% interest. So that 12% interest is the cost of that loan, right? So which means it's going to be your monthly payment for that particular loan, right? Then, which means in your question, what you need when you are calculating the weighted average cost of capital, you determine the components that makes up the capital structure. Then you convert them to present value, right? When you convert them to present value, you are done with the market value. Remember, in our capital structure, the capital structure will be like this. So which means we have our capital, then we have our market value, then we'll have our weight, then cost of capital, then we'll have our weighted average cost of capital. This is how it should look like. At third level, you should use this table. So what it means now here is you are going to determine the market value of ordinary shares. You determine the market value of ordinary shares. Long-term loan, if it is the one that is there. Debentures, if they are there, you determine, which means you first need to do your calculation for the market values of these. Then you come and put the market values here. What we call a weight is a proportion of, like in this case, after you have your market value, you are going to have a total here. So when you have this total now, you are now going to say your weight is now the percentage of ordinary shares in the capital structure. So which means it's going to be your ordinary share over total, you convert it to percentage. The same applies to the long-term loan. It's going to be long-term loan market value over total market value. That is going to be your weight here. Then you have calculated this market value. Remember, you need to have the present value of this. Then you should also have calculated the cost. The two things that need to be calculated when you are doing your weighted average cost of capital. The first thing before you even answer the question is to determine here and to determine the cost of capital. So the cost of capital that you have calculated, you just come and put them here. Your weighted average now is going to be your weight times your cost. Then it's going to give you your weighted average. Then once you have the weighted average of each line, then you add the total that you have is going to be your weighted average cost of capital. So what I will emphasize when you are answering the question for weighted average, you need to determine the market values of the capital in the capital structure. That's the first thing. Then you determine the cost of the capital. That's the second calculation. Once you are done, you come and fill in here. You have everything that you need to fill in here. So the first thing is to calculate the present value of these ordinary share long-term loan debentures. Then you do your calculations for the cost of capital. And don't forget, when you are doing your cost of capital, to do the after tax for debentures and loan. So those ones will be after tax. But in some of the questions, it depends. If they are silent, then it means it's not after tax. But if they say it's after tax, then you know you are sorted. You're not going to calculate it. But if they are silent, you need to apply the after tax. Most of the questions, they are silent. They don't say before tax or after tax. So which means you know I'm going to apply the after tax. So that's basically how we do our weighted average cost of capital. This is a simple thing, which in the exam is the one that you should maximize your marks, because there is no way you cannot be able to punch in and get the present value here and calculate this cost and then come and fill this table. If it is 20 marks, those will be free 20 marks in the exam, right? Unless if there is a question, I want us to go through this question quickly. I want us to do this question together. There's a question that I'm going to give you guys. I want to see if we are moving together, because where we are now, we are now at the middle of the journey. So we need to see how we can be able to arrive. We are now at the middle. So from this point forward, I think we are going to be a bit more strict. If I give you guys work to do, you need to do it, because at the end of the year, we don't want people who will be crying, and we want people to be smiling when they got their results. The only way you can be smiling when you got your results is to sweat now, then you smile when you got your results. So let us sweat now with the work so that we can smile at the end of the year. Right. Right. Let's look at this question, unless if there's anyone with any other question that you have from what we have just discussed. Let's look at this question, the long question, together. Right. Let's look at the question here. They say Kingston Limited is a medium-sized manufacturing business that is highly dependent on electricity for production. Due to the recent load shedding, the production and profit of the company is under massive strain. The directors have decided to invest in a solar power system as an alternative source to minimize the impact of load shedding on the business, as there is no other short to medium term solution to the national electricity crisis. I think this is what we are experiencing now. The project cost, so we should also try to do this, to invest in this solar thing. The project cost is estimated at 13 million and will commence as soon as the funding of the project is confirmed. In order to evaluate the feasibility of the project, the company needs to establish the company's weighted average cost of capital. In your question, already you know what is going to happen. The company needs to establish the company's weighted average cost of capital. So they give you the extract from the financial statement. We have equity, we have everything. I always prefer the notes. Let's go to the notes. On the notes, they say the historical average issue price of ordinary share is 250 cents. The latest known share price is, so we have two prices for the share. This is the historical and this is the latest. Then Kingston Limited has just declared and paid a dividend of 25 cents in line with its stable annual growth. The company is expecting to declare a dividend of 28 cents for the year ended 31 March. Already you have your answer when you want to calculate the market value or the cost of ordinary share, you already have your figures here. You have G0, you have your D1 here. So your G is going to come from these two figures. Then your market value is going to be here. If the company, if they requires you to calculate the market value of ordinary shares, then you know you are going to use here. Right, let's look at what else is there. So in note number 1, we are going to have the market value, which is here. We are going to, the historical issue price, you are going to use it if you want to convert this. Let's say the question requires you to calculate the market, the market capitalization or the market value of ordinary shares. So that price for R2.50, you are going to use it to determine the number of shares that were issued. Remember we say number of shares. Remember we say please mute yourself. Mute yourself. There's a background sound there. Right, we were saying when you want to calculate the market value of ordinary shares, we say it's going to be number of shares times market price of the share. So which means this historical price, you are going to use it to convert this 40,000 into number of shares, so that you can now be able to multiply by the current share price. Then you already have your market value of ordinary shares. So that's basically, so when you are calculating your cost, so which means on note number 1, you must be able to calculate the market value and the cost. Your cost, you are going to use this. Remember we say KE is equal to D1 over PO plus G. So your PO, your D1 is going to be here, 28 cents. That's your D1, the expected dividend. That is going to be your D1. Then your PO is going to be the market price. Then your G now is going to be your 28 minus 25 divided by 25 times 100. Then you'll get the percentage for the growth. Then you are done with this first line. So which means you are going to have the market value. In your calculation for market value, first convert these to number of shares. The first thing is the formula. What is the formula for the market value of ordinary shares? It's going to be number of shares times the market value of a share. So are we provided with number of shares here? No. Then you need to convert these to number of shares. Ordinary share that was issued is 40 million at a price of 250 cents. So you need to convert it now to shares so that you can multiply by the market value of the share to get the market value of ordinary shares. Then it will be done there. Let's look at, once you see this part, then it means it's either you can use the capital asset pricing model. If in the question they give you this, the government bonds, all this, then it means you can now apply them into the capital asset pricing model. Right, so let's look at note number 3. They say similar debentures are trading at 10% per annum. This is another key area that I always see challenges. They say similar debentures are trading at 10% per annum. The interest is payable annually in arrears, and redemption date of these debentures is 31. You can see here they are redeemable debentures. So which means we're going to use the present value, all those things. But here, always look at this. Similar debentures, that's the percentage that you are going to take. This is the cost of capital. But there are two things now. We also need to see the percentage of the loan. When we take the loan, what was the percentage that we should pay? So we have two percentage here. So I always see people mixing those two. The one that came with the loan is the one that is going to attract the payments. So if you can see here on this debenture, there's a 12% debenture. So which means this is what is going to be your PMT. What you are going to be paying is either monthly whatsoever. So this is going to be your PMT. Then when you go to calculate your, this is now going to be, you now use the current cost. This is the similar debentures are trading at. So you now use the current cost. Remember, we're talking of bringing the figure to present value. So which means you now use the current cost of similar debentures here. So which means on number 3, we are going to calculate the present value of the debenture. When we are calculating the present value of the debenture, we're going to need this interest after tax. Then we need the PMT. PMT comes from what was the debenture's interest when you borrow from the bank. That is your PMT. You borrow a 12% debenture, so that is going to be your PMT. The bank will never change and say now, because similar debentures are now trading at 10%, so we are going to change your contract. They will not change. So which means that will be your PMT. Then another thing is your N. These debentures are going to be paid on 31 March. So which means you should determine which year are we and what is the financial year end and how many years now. So in this case, we are in 2016 to 2021. So you should look at your N is going to be 5 here. Then you look at your interest is going to be after tax. Right, then let's look at number 3. We're going to do the calculation. I'm just trying to elaborate so that when we do the calculations, we all know what is happening. Right, then number 3, they say the long-term loan is repayable in 3 years' time. So you already have your N. Your N for a long-term loan is 3 and carries an interest rate of prime rate minus 1%. We should now look at what is the prime lending rate here. Where is it? Did I leave something? Is there anyone who saw the prime lending rate? Because this figure, we normally don't guess it. Oh, guys, you're just quiet. It's here. Are you guys fine? Are you there?
Yes, we are here.
Okay, you're just leaving me getting lost. I was looking for the prime rate. So the prime rate is here. Sorry?
2%. What? Okay.
This is the prime rate. So when it is like this, they say the long term is repayable in 3 years' time and carries an interest rate of prime minus 1. You see, this one is, so you are going to minus 1 from this one. This is the current prime rate, so you are going to minus 1. This interest rate is the rate which the loan came with from the bank. So this is the one that you are going to use to calculate your PMT. The payments are going to be determined by the interest rate that which the money you borrow came with. So that is going to be your PMT. Then similar loans trade at prime plus 2%. So which means that's the present value of the loan. So when you calculate the present value of the loan now, you are now going to use this percentage. So don't confuse these two percentage, the one for PMT and the one to apply in the present value. This, the one that the loan came with from the bank, you are going to use it to calculate PMT, and always know it's going to be after tax. All PMTs, all percentages must be after tax. So that's basically here on debentures and long-term loan. Always look at who is going to be PMT and who is going to be the present value interest. Present value interest is similar debentures are trading at, which means that's the current now. So you are going to use that one when you want to bring this amount to present value. So that's basically there. So let's look at the question. In our exam, the question here, I just choose this question because it's the exam will not tell us things like this. The exam will just come here and say, calculate the weighted average cost of capital, then 25 marks. How you get there is now you. How you get to the weighted average cost of capital, you need now to use your understanding. So which means here we're just trying to illustrate so that we all understand. But as we go, you'll see the question I'm going to post now is going to be here. Calculate the weighted average cost of capital. So remember, we're saying you start with this, the cost and the market value. So which means here they illustrate. The first one say calculate the cost of the loan. Right. So here they say calculate the cost of debt, the loan. How do we calculate the cost of the loan? It's here. Based on what we have been doing, how do we come up with the cost of the loan? The loan is repayable in 3 years' time and carries an interest rate of prime rate. The current rate, prime rate is 10.5%. Similar loans. So how do we determine the cost of the debt here? As per our discussion, you guys, how are we going to determine the cost of the debt?
We say the prime rate minus 1 times 0.72 if the tax is 28%.
Are we gonna use -1 or use the +2? Remember, we need the cost of the debt. We don't want the payment, the PMT. So we are going to use this one. Am I right? Similar loans. Remember, I said the cost is now going to be similar loans trade at prime plus 2%. So which means your cost of debt is going to be 10.5% plus 2%. Then your after tax times 0.72 as per this question. Let's just use this one for this question, which is going to be how much there the cost of debt. If we add 2% to 10.5, we're going to have 12.5. Then we multiply by 0.72. How much are we going to have? It's going to be 12.
%.
So the cost of debt is going to be 9%. That's the cost of debt. We'll be done with the cost of the debt. Here is where I see a lot of challenges here. these two percentages, the one that the loan came with from the bank, you use it to determine PMT, the payment, when you calculate the present value of this loan. Then the one that you are going to use when you calculate the present value is the one that is the current one. Similar loans are trading at, which means that's the current one. So the current one, you just need to bring it to after tax. Then that is going to be the cost of debt. Then let's calculate the cost of the debenture. How are we going to calculate the cost of the debenture? The cost of the debenture is similar debentures are trading at 10% per annum. So the cost of the debenture is going to be how much there? 10% times 0.7. Am I right?
Yes.
How much are we going to have? Are we together here, guys? Are we together? I want us to understand this thing, because this is the real thing that we will meet in the exam. No way we can run away from this question, especially in the finance part. In your finance question, expect weighted average cost of capital, ratios, business valuation, and capital budgeting. Those ones, you need to expect those 4 topics, and you need to master those 4 topics in finance. What are we going to have? So at this point, this is the point where everyone must understand, so that as you go along doing your calculations, then you know this is how we did it in class, or this is how we did it in class. So this one is going to be 7.2%, né?
Yes.
Right. I'll jump this one still. We can use the Gordon. Okay, let's calculate the cost of equity using the Gordon's dividend growth. I will not do this one. This one is for second year. For third year, not to use this Gordon's dividend. Right. So let's calculate the cost of equity using Gordon's dividend growth model. So it's going.
No, the 0.72 is what is for tax.
Yes. Do you see where it is coming from? We say 1 minus 28. Then we'll be left with 72%. You can still use it like.
Why are we saying 1 minus 28?
After tax. It will be after tax. Remember, our tax is 28%. So here we're applying after tax. The 07.2 is going to be after tax. After we deduct tax. Remember, we agree that a loan is going to attract tax. So this is the after tax that we are talking about here. I don't know if you are together, you guys. Are we together there?
Yes, I think the best way maybe is to explain that. For me to understand it, because I was a bit confused. Then I went to the formula. So I started with the formula, then I got it right.
The formula was what?
Yeah, KD equals to a percentage cost times, then you open the bracket, 1 minus 28%, you close the bracket. Then that she will able to get that amount.
Yeah, you are right there. Us here, we just took a shortcut. Yeah, it's still.
You took a shortcut, yeah.
Yeah.
Okay.
Yeah, but I want you to know the shortcut so that in the exam you don't need to take too much time on. You should know the shortcuts so that in the exam we just go straight to the answer. because remember these guys, they don't mind about, they just want you to show this part in the answer. So that, remember here we're trying to calculate the cost and the market values, so that we can now be able to do the weighted average cost. Like, let's now do the Gordon's dividend growth. The Gordon's dividend growth is going to need your formula. So which means this one is going to be our C, is the cost of ordinary share. So it's going to, we're going to use Gordon. So it's going to be KE. Let's put the formula over, it's going to be D1 over PO plus what? Plus G, am I right? So it's going to be, who is going to be our D1 here? Who is our D1 is the question there?
28 cents.
It's expected dividends.
28 cents. And who is going
Yeah.
to be our PO is going to be who?
25 cents.
PO.
Oh, so I thought you were saying D. Sorry.
Okay, Lulu.
Mhm.
So 625 is going to be our PO, am I right?
PO, yes, yes.
So which means our D1 is going to be 28 over 625 plus. So our KE here plus the growth. So the growth now is now, so when you calculate the growth, remember it was 25. The previous year's dividend was 25. Then it goes to the expected 28. So that's where the growth is going to come from. So which means now you are going to say your growth is going to be 28 minus the 25 over what?
25. Oh.
Yeah, over 25 times 100.
100.
It's going to give us how much there? How much else do we have? So the first thing is you are going to get 3 over 25. So you just say 3 divided by 25. So just leave it like that. It will be 0.12, or you can convert it to percentage. It will be 12%. So let's work here now so that we get this one. So it's going to be 28 divided by 625. So this one is giving me, so it's going to be 0.048 plus 0.12. How much are we going to get? Plus 0.12. 0.1648, am I right? So when you convert it to percentage, it is still going to give you 16.48%.
Why am I getting a different number? Look.
How are you applying your are you here? Are you getting a different number here?
28 divided by 625.
Oh, you just say 28 divided by 625. It's going to be 0. I'm getting 0.0448.
Okay. I'm getting
I'm getting 0.04.
Yeah.
Yeah, 0.05.
I'm getting
0.045.
I think your calculator is rounding quickly.
Yeah, I'm getting 0.045.
It's rounding. Oh, what you can do?
Then it says 0.04.
Yeah.
Mine it says 0.04.
You guys, your calculators. I think I'll check for you the which calculator are you using. You should
Financial calculator, HP.
Financial sharp.
what
I'm
you
using
should,
HP.
you should do what you should do is when you are doing using a financial calculator, set it to 4 decimals.
4, okay, all right.
So that it doesn't round. Set it to 4 decimals so that it doesn't round. Because once it starts to round so early, your final answer will be different, totally different. You must round at your last answer. That's where you should round. So set it to 4 decimals so that it doesn't round. Because if it is on 2 decimals, then it quickly round off. Right, so this is going to be our cost of debenture, right? Unless if there's anything else on you guys, then let's look at the market value of the loan. How are we going to determine the market value of the loan? Let's go to the loan. The long-term loan is repayable in 3 years' time and carries an interest rate of prime minus 1%. Okay. Then they say the current prime rate, we already have the cost here. So when you are calculating the market value of the long-term loan, so let's just come here and try to calculate it here. We want to calculate, so it's going to be the market value. The market value of the loan, that when you are calculating the market value of this loan, it means you need your present value of the loan, your future value. What else do we need? We need N, am I right? We need interest. Let me just use my whiteboard. I think this space is too small. Because this one you guys need to. Right, so we want to calculate the market value of the loan. That is going to be our D. Right, when you are calculating the market value, so it means you are going to need your present value. That's what you want to calculate. You need to see who is the future value, who is N, who is interest, and who is PMT, so that you can be able to calculate the market value. So let's quickly calculate the market value of the loan. Let's go to the question and see which figures are we going to need. Okay. Right, which figures are we going to need on the market value of the loan? We need FV. The FV is going to be 10,000. Am I right? This is going to be our FV. Then from there we need N. N we say is what? The loan is going to be paid in 3 years. So this is going to be our N. Then what else do we need? The cost, we already have 9%. So which means we're going to have we are going to have our future value. We say it's going to be 10 million, sorry. Then our N we say is 3. This one we already calculated it. We say it's the market value of the loan we say is 9%. So this is going to be our our interest. Right. So we need PMT. So when you are calculating your PMT now, you now need to come here. When you are calculating your PMT, you look at the interest at which the loan came with from the bank. So they say the long-term loan carries an interest rate of prime rate minus 1%. So that is going to be your PMT. So our PMT is going to be 10.5 minus 1%. Then times 0.72. Remember, I always need the shortcut. So that is going to be your after-tax interest. So which means we are going to now to calculate the PMT using this after-tax percentage. Let's see how do we put it on paper. Right, so which means our PMT is going to be 10 million, sorry.
10 million times 9% times 0.72.
We are no more going to take 9% now. We are going to take the one that it comes with from the bank, which is going to be the 10.5 minus 1% times 0.72. I don't know if you guys understand what I'm trying to do. Are we together on this PMT? Or we are lost?
Yes. We are together.
We're taking the 10.5.
Remember here, that's why I was emphasizing here that here we are here. Let me go back. I want you guys to understand there's nothing to rush here. This is class, it's not exam. We'll rush when we are in the exam. Here we need to understand. Right. What I was trying to say here is there are two things that you need to consider here. The present value of the present interest rate of the loan is this. Similar loans trade at prime rate plus 2%. So that is the one that we convert and it becomes 9%. So when you calculate your present value, it means you are going to use that percentage because you are calculating the present value of the loan. But when you calculate PMT, remember the bank will never change the interest rate they charge you when you apply the loan. So you are now going to use, when you calculate your PMT, you are now going to use the interest that you were charged when you borrowed the money from the bank. So here they say the long-term loan is repayable in 3 years' time and carries an interest rate of prime rate minus 1. That's where that figure is coming from. So which means our PMT, the payments that we are going to do, are going to come from this percentage, the prime rate minus 1%. That is going to be what we'll be paying to the bank. But this one, we want to use it to calculate the present value of the loan. So this is the present cost of capital. So that's why we took this one when we calculate now the cost of capital. I don't know if it's clear now. So don't confuse these two percentages when you are doing your calculations. Don't confuse them. There are two percentages, the present value percentage and the one that you are going to use to calculate PMT. Right, what is going to be our PMT here?
I got 684,000.
684.
Zero,
That
zero,
is our
zero.
PMT. What is going to happen now? We want to punch. That's another key area that I have seen people punching. They just punch, right? Here, when you are here, when you are punching into your financial calculator, it doesn't mean you always put negative to PMT, but it depends on what is happening to PMT. Is there money coming out of the business? Then you put negative. This one is going to be a negative. Am I right? Because the money is coming out of the business. So when you punch here, you're going to put a negative. When you are doing your questions like on debentures and what else? Leases and debentures, you may find that this PMT is not going to have a negative. Why? Because you are the leaser. So there's money coming into the business. So you don't put a negative because there's money coming into the business. So it's not like always we should always have a negative on PMT. It depends on what is happening to the cash flow. Is it a cash outflow or cash inflow? That's when you put a negative here. So always examine the business that you are dealing with. Did the business took out is going to pay or is going to receive? Then you know you are going to put a negative or not. Then again, the same thing to the future value. This is a loan that was taken. Obvious, when we pay, it's going to be an outflow. So you are going to put a negative again because it's going to be an outflow to the business. If it was us who give someone a loan, we're not going to put a negative here because we're going to receive money at the end of the day. So those are some of the small that makes you, when you calculate, then you say, my present value is different from others. It's because of this negative. So let's punch in and get them the present value. Let's all try to punch and see if we can come up with the present value.
Sorry, I can't get the 684. I don't know. How did I punch it?
Right. If you are using, what you can do is first work out here. After tax, what are you going to get after tax? This one, this part. Then you can multiply it by 10,000, 10 million. So
do you have to put those percentage or not?
It depends on your calculator now. Some of the calculator, they will not allow you this percentage. It depends.
I didn't put it. I got 6.8400. Then I times it by that 10 million, but I don't get the 684,000. Don't know whether it's me.
How many of us got
Not
this?
six,
Hello?
it's not 684,000. It's 684,000,000.
No. That answer is correct.
Yes. It's not correct. 684,000.
10,000. 10 million times
What do you guys get
6.84%.
here? What if you want to simplify?
6.84%.
If you want to make life easier, first calculate here. This part.
Okay. Yeah, I did. It's 6.8400. That's what I get.
6.8400.
Yes.
No, it's 6.84%.
Yeah, 6.84%. So
Times
here
10
it's
million.
8,400 million.
Then times 10 million divided by 100.
You guys,
I got 684,000. The same one.
Yeah.
That's the correct figure. Even me,
It's not the right answer, 684,000.
Started with 10.5% minus 1%.
What you should do here, look here, you guys, what you must do here, let me show you the easy way. Come here. First subtract this 1% from 10.5. What are you going to get? you are going to get 9.5 what? Percent. Am I right?
Yes.
Then you
Times 0.72, it's 6.84%.
then how much are you going to get after you multiply by this one?
6.84%.
6.84%.
Yeah, and then times by 10 million, not 10,000.
It's 10 million here.
That's 10 million. It's fine.
It's 10
Divide by
million.
100.
No, why you divide by 100 after that?
No,
No, you don't
guys,
have to divide.
we shouldn't be taking too much on this calculation. This is straightforward. Because I don't know what's
Because it's a percentage.
We shouldn't be taking
Love,
time.
no, we have to divide by 100 after that. No.
Yeah, it's a percentage.
What you do, you guys, is you get 6.84%. You just punch it straight.
Yes.
6.84% times 10 million. It will give you the figure of PMT.
Yeah, we don't have more. Can you clarify this? If we say 6.84%, we times by 10 million, do we have to say divide by 100?
You guys.
No.
If you
No.
say
No.
6%,
We don't
you
divide
don't
by
have to
100.
divide by
We
100.
don't. That's why I don't understand. So the answer is wrong.
No, the answer is right.
No, it's right. You know what you need to do next, right? I got it right now. It's 6.84%. Use the percentage on your calculator. If you don't use it, you're not going to get applied. Yes, now I got it right.
If you don't want to, you see, let's say your calculator does not have a function for percentage. Either you have
That is why you divide by 100.
You have 6.84. You can just multiply by 0. What is it? 0.684. I think it will give you the straight figure. That is if your calculator is an option for a percentage, just go straight and apply the percentage. That's the easy one in the exam. But remember, in the exam there is no time. Let's quickly calculate our time. Let's quickly calculate the present value now. Let's punch in. I think I've explained these negatives. So let's punch in and get the present value. Let's quickly. Okay. How much do you guys have on the present value? Yeah, you're taking long. It's just a matter of going to your financial calculator. Negative 10 million, you press.
Yes.
Then you go 3 N interest 9 PMT negative. This one. Then you go and compute present value. It's going to give you the answer. Life easier now with this financial calculator. Yeah. What is going to be the answer now?
Wait, you're still busy.
You guys, you can't take hours to do this thing.
Is it since minus 684 there?
Yeah, negative. I remember I was explaining this thing. I was saying
mine it said 7721834.8.
The present value.
Yeah. I don't know.
Anyone else who got the present value?
I don't know. I got 9,453,217.57.
Yeah, you can.
It's 9,453,217.57.
Yeah, you can just leave it like you can round it.
Then it's 218 if you round it.
So that is going to be our present value of the loan. Now let's do the next one. The market value of the debenture. So let's do the market value of the debenture. The market value of debenture. It's still the same thing. You need your PMT, you need your I, you need your N, then you need your FV, then you need your present value. That's the one that we are calculating. Market value is present value. So don't confuse market value. So this I, we already calculated. So let's go to the question where we did the calculation, check the I. We did it here. The market value, the cost of the debenture, we say is 7.2, and the future value, you get it here. 12% debenture, 16 million is going to be the future value of the debenture. So already we have our I, which is going to be 7.2%. Then we have our here, which is 16 million. So we are left with PMT and N, which is going to be our N here. The debenture is going to be paid when?
Annually.
31 March 20. Oh no, 2020, 2021.
It's
So
3 years.
So from 2016 to
16
2020.
minus 3 is 3.
Huh? We are in which year here? We are in 2016. 31 March 2016. So we start from 31 March 2016 to 31 March 2021. It's 5 years. Am I right?
Yes.
Yes.
You guys, this one it's here. It's here. The debenture is redeemable on 31 March here. So that's the end. That's the period upon which we should keep the debenture. From 2016 to 31 March is going to be 5 years. So that one is now going to give you your N is 5 years. So we are left with PMT now. Let's go and figure out how do we get the PMT, right? How do we determine the debenture came with 12%, am I right? So this is where you get a PMT. The percentage at which the debenture came with from the bank is that's what you are going to pay. If you go today to the bank, they will tell you that, you know what, your loan is going to attract an interest of whatever. So that is going to be what you will be paying on that. So which means we are going to have 12%. So it's going to be 16 million times what? That 12%. Then we apply the after tax. How much are we going to have as our PMT? Don't tell me.
1,382,400.
1,382,400. Then we can now calculate our present value. Remember, this is a debenture. This is a loan. So these guys are going to pay. It's a cash flow outflow here. It's a cash outflow here. So we put negative. It's all cash outflow. As long as you have these two, the only advantage is if you don't have FV, you only have PMT and this one and this one. You want to calculate the present value. It's not going to affect, but you have a figure with a negative as your answer. But as long as there are two PMT and future value, the moment you don't go right on these signs, then your answer is going to be wrong. So always understand when and where to put the negatives. It's not always PMTs must be negative. It depends if it is a cash outflow. It's not always FV is going to be a negative. It depends if FV is an outflow. Us is an outflow here in this business because they are going to pay this money after the 5 years. So it's going to be an outflow. But if we were the ones who give the loan, it was not going to be an outflow. What is now going to be an outflow? Let's say you are the one who give the loan. Is going to be the present value. So which means if you are to calculate and the present value figure is there, it's going to be negative because at the moment it's an outflow. So in that case, the present value is going to be an outflow because you are giving out cash. So that's basically how we determine this negative sign. Right. So let's calculate the present value of the debenture. It's just a bit of,
16,939.
sorry.
16,939,648.13.
16,939,648. So this is going to be the market value. Remember where we use these, we're going to use them there in the weighted average cost of capital. That's where we are going to use them. So let's do the last one, that is the market value of equity. Let's do the last calculation, that is going to be the market value of equity. Market value of equity is number of shares times market value of share right. So that's the formula that you use when you want to do the market value of equity. So let's go and look at what is the market value of you want the number of shares. So when you are determining the number of shares, you come here. The historical average price per ordinary share is 250 cents. So how many shares were issued? So which means you are going to divide, this is the value of shares which were issued. So we're going to divide 40 million over 2 rand 50. Then it's going to give us the number of shares. Then our market value is going to be 6 rand 25. Then we get our market capitalization there. So which means our market capitalization is now going to be 40. We need first the number of shares, which is going to be 40 million divided by 2 rand 50 times 6 rand 25. That's our market capitalization. How many shares are we going to have there? 40 million divided by 2 rand 50. How many shares are there? 16 million. Am I right?
Yes.
16 million times 6.25. So this is going to be the market value so the value of equity is going to be what? We just multiply here. How much are we going to get?
100 million.
So the value of equity is going to be 100 million. Right. When we are done here, then we go to the last part. But remember, I said that last part in your exam is the one they just ask. They will never talk about all these calculations for market value whatsoever. They will just come here and say, they will give you this whole long story. Then they will come here and say, calculate the weighted
Love more,
average.
can you copy that site for ordinary share?
where we're calculating ordinary shares. Sorry? You
Yes,
said?
I want to understand something there.
Okay.
Yes, please, can you go back that? Can you go back to the ordinary shares calculation?
Okay, it's here.
Yeah, the first step is at 40 million divided by 250 times it's 1 million, right?
If you divide
That one.
R2.50 into 40 million, you should get 16,000 shares.
And then times by times 6 around 25.
Yes.
It's
What is
the
important?
answer it's not 1 million.
You are getting 1 million.
It's
No.
16 million, not 16,000.
What are you guys saying?
Okay.
Are we having 15 million here or what?
16 million. You said 16,000. I think she used that to
No, it's
calculate.
16 million here. 1, 2, 3, 1, 2, 3. So if you multiply 16 million by 6.25, then we get this 100 million. Am I right?
Yes.
So what is important is here. When you are doing your market capitalization, just know this part. Number of shares times market value of share. Number of shares times. So here you convert to shares, which is 16,000 shares, times the market value of share, which is R6.25 that is given in the question. Then you get your market value of the share. I don't know if there is anything else there.
Okay, thanks. I understand.
Right. So the last thing that you do is we only have 4 minutes. I will just show you how to do them. And that one is easy. That's why they give you 3 marks. So the last part is going to be your weighted average cost of capital. So in your weighted average cost of capital, you have the capital, you have the market value, then you have the weight, then we have the cost of capital, then you have the weighted average cost for each line. So in our question, the capitals that we have ordinary share, we have what else? Long-term loan, then we have the debenture, then you will need a total here. Right, so we need the market values, the one that we just calculated. Let's just go there. So the market value of ordinary share is of debenture is 16,939,648. Then the one from ordinary is 100. So we are going to have 100 here. Then the one for debenture, we say it's 939,648. Then let's look for the one for the loan. Here we're no more going to go to the, you have already done your calculation. The loan, we say we have 953,218. 953,218. So the loan is going to be 95.
I think that one is wrong.
It's wrong. Which one is correct?
Loan 4.
That one is it's 9,453,240.
9 million.
9 million.
Yeah. 453.
453.
240. Are you
240.
guys comfortable with this punching? Because that's where the problem is now. Because if we are having challenges with punching in the financial calculator, the finance part of MAC is going to be a challenge. We need to practice how to use our financial calculators, because most of the questions they require us to. So how much are we going to have here as a total? So when you are here, let's just go to the cost. So this one, the one for ordinary share, we say it has 16.48%. Then the debenture, we say, how much did we say is for the debenture on the cost? 7.2. The one that we calculate. Then this one we say is 9%.
Yes, 9.
So what we need now is a total here. We need a total here. We add all the market values. The total, we use it to determine the weight. Remember when we started, I said, you are going to use this total that you have here to determine the weight. The weight is the component of ordinary share into the total capital structure. So that's the percentage that you are calculating here. So in all, how much are we having here as our total here? 100 plus 16 plus 9.
126 million. 392.
392, 888.
888. So now, when you have this total now, what you are going to do, when you want to calculate the weight of ordinary shares, you say 100 over this figure. Say 100 over. How much are we going to have there? How much are we going to have? 79%.
Yeah.
Then here you say 9,453,240 over 126. Anyone who got it? Let's just finish off. Let's finish off. So this one you are going to have 13%. Ne? And the last one, I think it must give us if we add 79 plus 13, how much are we going to have? Because at the end it must give us 100. I don't know if you guys understand what I'm trying to say. Plus 13, we have 92. So this one is going to be 8%, the difference to make it 100 here. Right. When we have our percentage, I'll just show you guys how you're gonna finish this. You multiply to get here. You are going to multiply 79% times this one. Then you get your figure here. The same applies to here. You multiply, you get your figure here. The same applies to here. You multiply, you get your figure here. When you get your figures, you now add them. What you have, the total here is going to be your weighted average cost of capital. That is going to be the weighted. After you add this, this, and this, then you have your weighted average cost of capital. I don't know if there's anyone with a question before we close the class.
How did
The weight of the loan, I don't think is 13%.
It's how much? How much do you get?
0.0748.
0, 0,
It's vice versa.
oh, I put vice versa.
0.748.
So this one should come here. This one is 13. The 13% is this one. The 8% is this one. Right. So this is how, so you just need to multiply here by here. Then you get here, here by here, you get here, here by here, you get here. Then you add this one. Then that is going to be your weighted average cost of capital that you are going to put into the answer. So what you guys need to understand on this question is, if the question gives you a scenario and then they say calculate the weighted average cost of capital, the first thing that you ask yourself is, what do I need to calculate the weighted average cost of capital? I need the market value, I need the capitals, I need the cost of capital. So which means the first thing is to determine who is in the capital structure, which is here. Then you now determine their market value, like what we did. Then you now determine their cost. Once you do the calculation, this table is just copying and paste from your calculation, which means more marks are on coming up with these figures. You will see that the marks are on calculations. They are not on this table. So even if you don't have time, it's better not to come up with this table in the exam. It's better to come up with the calculation, because the calculations are the ones that has marks. And remember, in our Mac FAC, if you present an answer without calculation, automatically it's a 0 on that answer. So even if you don't have time to write the full thing, don't start with the answer. It's better to submit the calculations than to submit this table and expect a mark from it. They will never mark it. They will just cancel it because they don't know where do you get this figure. So if you don't have time in the exam, just try to do the calculations only and leave this thing. Then they will get marks on the calculations. Okay, unless if there is anyone with a question, I think we're gonna close our class.
I do have 16.48. Please help. Cost of capital, what percentage?
Which one?
16.48
Oh, the 16.4.
for ordinary shares. Yeah.
Okay, let me just go back there. Okay. Where is it? Oh, it's here on here. Sorry. Okay, you are asking here, ne? You are on here.
Oh, it's that one. Okay, no, I get it. So,
okay, so this
right.
is how we got it. Yeah, this is how.
That's okay. Okay.
Right?
Right.
Any other question before we close the class? So you guys, I will send a question, then we'll close with that question in our next class. I'll send a long question that you guys can try. Then that will be the closure for the topic.
Can you send this one as well, ne?
No, this one we have it on our notes. Ne? It's here.
Oh, okay.
This one is here. It's on the notes. If you scroll down the notes, you'll see this question.
Okay. And then you say you were saying it's not always the case that the PV and the FV and the PMT that we should put minus. It's not always the case.
No, it's not always the case. It depends on, is there a cash outflow? Are you having a cash outflow? Sometimes you may find that a PMT for another business, PMT is an inflow. So you don't put a negative to an inflow. For an example, if you issue a debenture, let's say in this question you are the one who issued the debenture, then you can't call that PMT an outflow because you are going to receive the money from the person that that is going to pay. So that will be an inflow. So it's not going to be. I will show you even when we are doing leases. I see a lot of errors when people are doing leases. They mix these things. Just like when you are doing a LISA, you can't say PMT under the LISA is negative. A LISA is going to receive the money, so it can't be negative. The future value of the lease is going to come to the leaser, so it's not going to be negative. So those are some of the small that you need to understand when you are busy with your question papers. So it's not always negative. Look at the flow of cash. Is it in or out? I don't know if we are together there.
Yeah, it's difficult to check that.
Yeah?
Yes, yeah.
You see how you check it, you know how you check it. Let me give you an example of, like here in this question. If we were not dealing with Kingston, let's say we're dealing with the one that is going to that is given the loan. If the bank FNB is the one that need to calculate the present value, they are the one who are going to receive this money, this PMT, which means they are not going to say it is an outflow because they are the one who are going to receive the money. That's the only thing that you look into a question. But for MAC, it's fine. Most of your questions, PMT will negate. But for leases, for those who are doing FAC, you should always be careful who is receiving the money. Then you know whether PMT is negative or not. But for MAC, most of the questions, you will always find your PMT and future value is negative. Because in MAC, you are looking at us borrowing money to finance our business. So that's there. Unless if there's another question, then we can have.
Yes.
Yes.
Sorry, man. Let's go back to C. Let's go back to C from that amount 28 minus 25 divided by 25 times 100.
The dividend.
But I get 12. Yeah, I get 12 instead of 0.12. Don't know what did I do here. Yeah, okay, 28 minus 25, right? Divided by 25
Well,
times
yeah,
100.
okay. What we did, I did not multiply by 100 here.
Yeah.
Now I don't get it.
But yeah, I did not. You see, the other thing that I always wanted to be like this, so that when you add it to this one, it won't give you a problem. Because yeah,
So we don't have to multiply by 100 then.
You can multiply by 100 on the final answer, it's still fine. Like here, you see.
But you're not getting the same answer if I do that.
If you multiply by 100. Here you get
so it's going to be 0.048, right? Plus 12.
How much are you getting?
Okay, 448 plus 12. It's 12.0448. There's a huge difference there.
You are getting how much? 12.
Okay, 12 times 100, right? Let's see. Okay, that's 12. So it's going to be 12 plus 0.0448. Plus 0.0480. Okay. It's 12.0448. That's my answer.
Where are you getting lost today? I think for you not to get lost much,
I must not put 100.
Yeah, don't put this 100 earlier. Put it at last. This 100. Just leave it so that you get the figure that is in the same category with this one. Then when you are here now, when you get your 0.1648 now, then you convert this one to percentage now. So which means now you are now going to multiply it by 100. Now you can get 16.48%.
Okay, class, am I the only one here who's getting this amount? Are you using, yeah, I'm using HP Financial Calculator.
I don't get the answer as well. I wanted to ask as well. I don't know what to
You guys, let's look at if we say 28
8, yeah.
minus 25, how much are we going to have?
3.
3.
3 divided by 25.
0.12.
Yes,
Yeah,
0,
that's
0.
this one.
Okay.
0.12.
This calculation.
So that's how you arrive here. So for you not to be lost too much, don't convert it here. Just get your 0.12. Then you come here now, you say 28 divided by 625. Then you just say 28 divided by 625. It's going to be 0.0448. Then you add it to 0.12. Then you get this one. When you have this one,
It's fine now.
it's not in percentage, this one. You need now to convert it to percentage now.
Okay, the percentage at the end. I think that's the best way because you know, I don't want to ask again because thereby I don't get those answers. But anyway, it's fine. You know what I'm thinking? It's the what do you call it? The 12 per year. Maybe I need to change that to something else.
Oh,
you know what? Yes, because I don't get those answers.
What you should do there again on your file, you see, let me just go to the question. When you are like here, it's the payment is one payment per year. So make sure that you set your financial calculator to one payment per year.
Good. Yeah.
You
No
see,
wonder.
when you are punching,
yes.
look at the question. How many payments are you going to make? It's either you can make 12 payments per year, 6 payments per year, 3 payments per year, 1 payment per year. So the first thing is to set your financial calculator to those payments. That's the only way you can get the correct answers.
Exactly. Perfect. Thank you.
The moment you have your financial calculator, the first thing, clear the memory, set your payment, then you can punch in the figures. The answers will be straight. You don't need to. But if you don't do that, then it's going to give you a problem.
I figure it out. Okay.
So
thank you.
Okay, we'll meet those who are coming on Saturday. We'll meet on Saturday for the physical.
Thank you.
All right, no, that's fine. Thank you so much. Good night.
Good night. Thank you so much.
You guys, are you there? Why are you quiet like you are not there? Hey, I wish if I was going to write Mac again. Yeah, it's interesting.